one thing that you've always told me in our discussions is you have to have obviously the capital and the courage to take advantage of these big drawdowns. And I've noticed something about myself because I reflect back on that wisdom that you've given me and the audience through our interviews. And I've noticed like every time I see like a big drop, I mean, we had it happen in October, we had it happen in the end of January, and even more so now. I feel this emotion come up in my body, in terms of like where it's almost like something that I have to go against because the emotion is to like get fearful, and I have to like do the opposite of what that emotion is and apply the logic. And so, is that something you had to practice for a while to kind of get?
Sure. Yeah. It took me 10 years to learn the game. In the decade of the 1970s, you'll recall from our earlier interviews, greatest bull market in precious metals in recorded history. And I confused the bull market with brains. I thought I was making money because I was smart. And I also didn't understand that markets worked. I didn't understand the cure for high prices was high prices, cure for low prices was low prices. But after I learned that lesson, and I learned it, as I told you, fairly dramatically in 1982, I went from being a very wealthy young man to having a net worth south of zero. Those lessons stuck with me. And the way you describe the lesson is the perfect way to describe it. As uncomfortable as you are in market declines, you need to project that lack of comfort on 2 or 3 million competing participants in the market. You need to think that the same trauma that you're experiencing is being experienced by others. And it's being experienced by others who may not be as solvent as you are. It is causing people, at the very least, not to buy, but in many circumstances, not to sell. Forcing them to sell. If you have a circumstance where it's more likely that you have sellers than you have buyers, it is more likely that you're going to be lonely on the bid, which is a very, very, very good place to be. It's wild to me that you have people lined up on the bid for a stock that's $3, and then the same stock 2 weeks later is $1.75, $1.80, and the people who just bought it for $3 want to sell it at $1.80. There's nothing changed with the company. I'm forever grateful, Daryl, if that's the case. There are some younger, harder working, smarter folks than me who consistently contribute to my economic well-being because they haven't figured out that you're supposed to buy low and sell high.
Yeah, for sure. So selling high. So I've been buying Wheaton precious metals for quite a while now. And recently it touched 165, somewhere around there. And I bought this recent sell-off overnight trading with my trading app. It hit 107, so I was able to get some shares at 107. And then morning came, and then we had to pivot on the threat, and then it's back up to 120 or 118, something like that. So I'm just curious, when you have an asset like Wheaton, in your portfolio, do you take profits on companies like that, or is that like a company where you're like, okay, this is like a super long term hold?
I haven't sold a share of Wheaton for years. I had the good fortune of being an original Wheaton River shareholder before Wheaton Silver got sold out of it. So, and that stock I sold a long time ago, before what is now Wheaton Precious came to exist. But really, for the last 7 years, it's been a one-way decision for me. It's been a buy decision. I have a fairly full allocation of Wheaton Precious, but every now and then I make some money on the speculative side of my portfolio. And when I do, and I reallocate some of that money to get it out of harm's way, I buy Wheaton anyway, despite the fact that I'm full. I regard Wheaton and Franco, and to a lesser degree, Agnico Eagle, as being absolute stalwarts in the gold business. And while I can't tell you what's going to happen to the gold price in the 3-month or 5-month or 6-month or 12-month time frame, I just have no idea. I feel very sanguine about the gold price in the 5-year time frame or the 10-year time frame for reasons that we've talked about. The consequence of that is that the most conservative way to express that fondness after buying gold itself would be to buy the very, very, very high quality precious metals producers like Wheaton. I think Daryl Thomas will thank himself for that purchase 5 years from now. I'm not sure you'll thank yourself for the purchase 5 weeks from now. I can't tell you how that's going to feel, but it kind of doesn't matter. It's really what it will do for you in terms of your strategic goal that's important.
Yeah, for sure. And so we have the junior miners and producers and such. Those have sold out significantly. So are you looking at allocating more capital there? Or
I am in the junior part of my portfolio as a consequence of selling out some mistakes and also taking a little profits. I've got a fair amount of liquidity, and I'm looking to get that allocated. I'm looking to get it spent. Is that to say that I think this is a market bottom? I have no earthly idea. But sometimes things are cheap enough. I think it was Bernard Baruch who said that the only guy who absolutely bought a bottom and sold at the top was a liar. It didn't happen. And you make your money by taking a great big fat slug out of the middle. And I reckon that some of the companies that I was looking at that seemed like they were high quality companies but were expensive, some of those companies are off 40 or 50% now. And could they be off 60? Sure. Do I really care? No.
Mm-hmm. Okay. And then do you have that same sentiment with the silver miners?
Yeah. No, absolutely. There's just so many fewer of them. But you're seeing, things like Pan American. Now, granted they had a production miss, but that's a high quality company is really, really, really selling off. I guess the one that sold off the most dramatically of the decent quality juniors has been Aya, which I'm very fond of. Now I have a very full position in Aya. I bought a lot at a much, much, much lower price. I'm a Benoit LaSalle fanboy, but the stock's off 40%. And I suspect that all the good news that was in the market around their new mine expansion has been knocked out of the market by sentiment. It's not like the mine got up and walked away. It's still there. It's just that people's fondness for it has gone away. Again, the social media adoration that company enjoyed 40% higher relative to the disgust displayed for the same range of assets, 40% lower, is hugely amusing to me. One of the interesting things I've observed in the market has been one of the justifications for selling has been the increase in oil price and the fact that the increase in oil price will increase the energy input and raise the all-in sustaining capital costs in the miners. And this is true. But if people are going to pay attention to that math, they have to pay attention to the fact that the miners themselves were priced on a discounted net present value basis as though the gold price were at $3,200 or $3,300. Granted, the gold price isn't at 54 anymore, but there's still a fairly substantial gap between the Wall Street and Bay Street assumption of the gold price and the price that companies are selling gold for. I was going to say to speculators, they can't have it both ways. They absolutely can have it both ways. They can make mistakes both ways and sell the stocks to me at a discount. That would be fine with me. I get off of my my educational high horse, and I get back to being a speculator. Um, so yeah, it's an interesting circumstance, and one where I think speculators have to deploy. I've told you before, Daryl. I've made a lot of what I made. I mean, I made a lot of it through hard work, being reasonably smart. But I made just as much by buying hate and selling love. And 3 weeks ago, 4 weeks ago, the markets were in love. That's when you sell. And right now, the market people are reacting with disgust, hate. You're supposed to buy.
Yeah. Yeah, for sure. So for those that are looking at the price of oil per barrel and how that impacts the margins for these producers, I mean, once you say that, well, that's also a reason why we invest in the royalty and streaming companies, because they don't have that operating cost.
That is also true. There is a subset of companies, as you point out, royalty and streaming companies, where you are not impacted by capital costs or operating costs. Very, very, very nice circumstance. We've talked before on your show, Daryl, about the fact that it would be entirely feasible to construct a whole natural resource portfolio, both mining and oil and gas, juniors and seniors, all from royalty and streaming companies. It's ironic, because they're great businesses, that in a rip-roaring bull market, that portfolio would likely underperform uh, a less intelligently constructed portfolio. But I suspect through thick and thin that the inherent advantages of the royalty and streaming companies would mean that a portfolio constructed both as to hydrocarbons and as to mining of royalty and streaming companies would probably, if it did underperform broader market in extractive industries, it would underperform it with much less risk.